The home loan rate war has seen big banks like SBI, ICICI, and Kotak offering mouth-watering interest rate of as low as 6.65% for a housing loan. The home loan rates are actually at a 15-year low. The banks flush with liquidity are tapping the mortgage buyers as the home loan are safe, secured, and also offer the opportunity to cross-sell more banking products in the future. But does a mortgage borrower understand the risk of interest rate rising tomorrow? The banks are offering these low rates at a time when the interest rates are likely to go up. Are banks making enough effort to make the borrower understand the likely possibility of higher EMIs outgo? Let's look at the risk and the possibilities that no banker would tell you. First and foremost, the interest rate offered by banks are floating in nature and not fixed rates. Banks today don't offer long-term fixed home loan rate as they don't like to lock interest rate for 15 to 20 years. Home loan rates are linked to an external benchmark, which is a repo rate in most of the cases. These rates are reviewed every 2 months by the Monetary Policy Committee. The banks are also required to reset their lending rates at least once in 3 months. So if the repo rate increases, the bank will quickly increase the home loan rates, which means higher EMIs. The transmission of interest rate is much faster when the repo rate increases and very slow when it goes down. The second important factor to understand is that the interest rates have almost bottomed out in the economy. In the last 2.5 years, the repo rate has gone down from 6.5% to 4%, which means a 250 basis point decline in the interest rate. The last downward revision in repo rate was done in May last year, almost 10 months ago. The rise in consumer price index or the retail inflation has already put a brake on any further repo rate cut. Globally, the huge borrowing by the governments is already pushing up the benchmark yields. The yields in the 10-year G-Sec market in India have moved up from 5.77% to 6.17%. Clearly, the cost of borrowing is rising. The retail inflation is currently at 5%, which is also above the targeted level of 4%. The current low interest rate are like a teaser loan rates attracting the borrowers with low rates which are not sustainable in future. The actual definition of teaser loan rate is something which is offered at a lower rate for a fixed period and later the floating rate kicks in. The current interest rate scenario is also quite similar, which will trap the borrower as interest rates are likely to move up. There is a lot of uncertainty regarding inflation and interest rate because of rising crude prices, huge government borrowing, and also a slowdown in the economy. The RBI had earlier discouraged the banks from offering teaser rates by insisting on higher provisions. This time around, there is no advisory from the RBI to caution the borrowers. The fourth important factor to look at is the cost of fund of a lending bank. Low cost CASA or the share of current and savings account in total deposit is very important. Higher the CASA, higher the capacity of the bank to absorb the interest rate increases. Currently, banks like ICICI, SDFC and Axis Bank has seen their CASA deposit share falling by 500 to 600 basis points in the last 3-4 years. SBI's CASA is more stable at 44%. Kotak Bank has also seen a huge jump in its CASA from 43% 4 years ago to 56%. Last but not the least is the entire interest rate structure of the bank. The credit risk premium is also part of the floating interest rate. The banks have the freedom to change the credit risk premium if they feel that the borrower's credit assessment has undergone a change. In an economy which is contracting, there is every possibility of a change in bankers' risk assessment of a borrower, which means higher interest rates. Operating cost is another component of floating interest rate. The banks also have the freedom to change the operating cost percentage if they want to in future. If that happens, interest rate will be adjusted upwards. Clearly, The low interest rate hides a lot which a borrower doesn't understand or know. Nor banks or the RBI is making any efforts to educate the borrowers.